You know the scene? It's a staple of dramatic cinema.
Oh, yeah.
The cobblestone street, the towering granite facade of some huge financial institution, and just the sheer panic visible in the crowds.
Right.
People are shouting, their faces are just etched with fear, they're clutching their bank books like life rafts, and there's this queue that just snakes out the door and around the corner.
And that line, that chaotic line, it's not just about money, is it?
No.
It's the physical manifestation of trust being revoked, institution by institution. It's fear made visible.
That image perfectly encapsulates the bank run. It's this phenomenon that has played out for centuries.
It's where cold economic reality just slams headlong into mass human psychology.
Yeah.
And it proves that fear is maybe the single greatest destabilizing force in finance.
Okay, so let's unpack this, because we've synthesized a really detailed body of sources that breaks down this critical concept.
Yeah.
We're starting from the underlying architecture of fractional reserve banking that makes banks, well, inherently vulnerable. And we're going all the way up to the very modern, lightning-fast threats posed by cyber failures.
And our mission today is to go beyond that simple definition. We need to understand not just what a mass withdrawal event is, but why. Why the belief that a bank might fail is so uniquely capable of becoming a self-fulfilling prophecy.
Right.
We'll trace the history. We'll delve deep into the core economic models that explain the panic. We'll quantify the massive societal costs involved and see how the digital age is completely redefining the speed and the nature of failure.
And the core definition is where that inherent fragility begins.
It is.
A bank run happens when many clients all at once withdraw cash from their deposit accounts because they suspect the institution is or might soon become insolvent.
And the action itself is fundamentally enabled by the fractional reserve banking system.
Yeah.
That's the critical starting point.
Explain that for us.
Well, in this system, the bank only keeps a fraction, a really, really small proportion of its deposits as physical cash reserves.
Okay.
The rest is lent out. It's working in the economy. So if a sufficient number of depositors demand their money back at the same time, the bank simply cannot meet those demands from its reserves.
It's not there.
It's not there. It forces them to try and liquidate long-term assets, sell off loans, and they have to do it at fire sale prices.
And that triggers the very failure they were afraid of.
Exactly. Now, if the funds are just transferred electronically to another, safer bank, the event is often characterized as capital flight.
Got it.
But the effect on the failing institution is, at the end of the day, the same. A severe, sudden liquidity crisis.
When we read about market turmoil, you hear these three terms: run, panic, crisis, and they get tossed around almost interchangeably.
All the time.
But our source material is very clear that they represent a distinct, escalating scale of financial distress. So I think it's important for us to define this hierarchy of doom based on how broadly the contagion spreads.
Absolutely. The smallest unit is the bank run, which we just defined. It's localized.
So one institution.
Exactly. It affects a single financial institution. For instance, if you hear a rumor that your local credit union is underwater and you move your funds to a big national chain, that's a run on the credit union.
And while that's damaging for them, the whole system doesn't collapse.
No, the broader system can often absorb it without any serious incident.
But the moment that fear jumps the fence,
that's when we enter the territory of a banking panic, or a bank panic. This is a much broader crisis. This is where many banks, often across a wide geographic area or an interconnected system, suffer simultaneous runs.
And this happens because people are losing faith not in just one bad actor, but in the whole setup.
The whole financial architecture. People aren't just moving funds from bank A to bank B anymore.
Right.
They are collectively trying to convert their threatened deposits into the safest possible asset, physical cash.
Or get out completely.
Or they're trying to exit the domestic banking system entirely, moving capital offshore if they can. It's a mass flight to quality, and it's driven by a really deep-seated distrust.
And then the apex of this disaster, the most severe level, is the systemic banking crisis. What defines this level is just the sheer scope of it. We're talking about almost all of the banking capital in an entire country being essentially wiped out or frozen.
When you reach that level, the cascading failure is devastating. I mean, truly devastating.
Why?
Because the entire mechanism that translates savings into productive investment just seizes up. It starves domestic businesses and consumers of capital.
So no loans for inventory for a small business.
No mortgages for families. No investment in new machinery for factories. This inevitably, and I mean inevitably, leads to a long, painful, and deep economic recession.
And this is where it gets really fascinating and, frankly, a little terrifying when we step back and actually quantify the sheer scale of the damage.
It's staggering.
We aren't talking about small market fluctuations here. We're talking about losses that cripple national economies for years.
The data available from comprehensive analyses of systemically important crises between 1970 and 2007, it paints a really grim picture of the aftermath.
Let's start with the fiscal costs.
Okay, so fiscal costs, that means the government money, taxpayer money necessary for the cleanup.
The bailouts.
The bailouts, the nationalizations, the restructuring, the guarantees. On average, those costs hit 13% of the country's gross domestic product.
13% of GDP.
To put that in perspective for you, that is a massive amount of public debt or wealth transfer necessary just to stabilize the banks that failed.
And that's just the public bill for the cleanup.
This says cleanup?
The actual economic output lost due to the freezing of credit and investment is even more staggering.
It's much worse.
Yeah.
The sources show that economic output losses averaged approximately 20% of GDP during the first 4 years alone of these crises.
20%, a fifth of a nation's entire economic output.
Gone. In the space of 4 years, it simply evaporates. And it's not just a momentary contraction, it's a sustained, years-long contraction.
Which means
Fewer jobs, less technological development, and lower standards of living for a generation. When you consider that level of macroeconomic destruction, you really start to understand the fierce urgency with which individual banks operate when they sense even the initial signs of trouble.
that leads perfectly into the bank's immediate mitigation strategies. So you're a bank manager, you see the first rumblings of a run. What are the first desperate steps you take to survive that liquidity squeeze?
The very first step is to frantically acquire cash. You have to prove you have the physical ability to meet withdrawals.
So you start calling other banks.
Immediately, you tap your lines of credit with other commercial banks. When that dries up, your ultimate lifeline is the central bank, which acts as the lender of last resort. Getting that emergency liquidity is job number one.
And at the same time, you're trying to manage the flow of money going out the door. You can't stop it, but you can slow it down.
Exactly. You might limit customer withdrawal amounts, imposing hard cash limits per day. Or you might institute scheduling.
What does that mean, scheduling?
If you can't get cash immediately, you schedule deliveries quickly to maintain the appearance of liquidity. You tell the customer, come back in an hour.
So you're managing expectations.
You're managing expectations and you're preventing the line from turning into a riot.
And internally, you're also trying to change the nature of your existing liabilities. You pivot aggressively toward encouraging high-return term deposits.
It's a really smart, incentivized strategy. They offer much higher interest rates to convince clients to move their liquid demand deposits, the money they can take out instantly, into fixed-term accounts that can't be withdrawn for 3, 6, or 12 months.
So you're locking the money down.
You are immediately reducing the bank's exposure to on-demand withdrawals. You're turning your most dangerous short-term liabilities into less risky long-term liabilities.
And if all of that fails, what's the nuclear option for an individual bank?
The temporary suspension of withdrawals. Historically, it was called a suspension of convertibility.
You just shut the doors.
You freeze the situation.
Yeah.
You halt the run entirely. Now, while it restores order by imposing a stop, it is a monumental signal of distress.
A huge red flag.
A huge red flag, and it usually requires government or regulatory sanction. But for a desperate bank, it can be the only way to avoid immediate bankruptcy.
Okay, we've established the chaos a bank run causes. But to really understand why this phenomenon is so central to finance, we have to look past the panic and deep into the underlying design of banking itself.
Right.
The fractional reserve system. Why is this model, which is so critical for economic growth, so inherently fragile?
The inherent vulnerability really stems from the fundamental service that banks provide to the economy.
Which is what?
They accept demand deposits.
Yeah.
That's money that you, the depositor, need to be liquid and instantly accessible. But if the bank just sat on that cash, it would provide no economic benefit. It would just be a vault.
So they invest it.
They invest the majority of those deposits into productive but illiquid assets.
And this creates the structural contradiction that every single bank lives with, which is the asset-liability mismatch.
Precisely. The bank's liabilities, your deposits, are highly liquid. They have the shortest possible maturity on demand.
Right now.
Right now. But the assets the bank holds are typically long-term loans. Think of the 30-year mortgage, the 5-year car loan, or the massive 10-year credit line to a manufacturing company that's building a new plant. These are long maturity assets.
So the bank has successfully created liquidity out of illiquidity. That's its core function.
It is. But it means that by design, no bank has enough immediate reserves to handle simultaneous withdrawal demands from all its liquid deposits. It just can't be done.
So the system works perfectly only as long as people behave in an uncorrelated fashion.
Exactly.
Which brings us to the foundational economic theory explaining this mechanism, the Diamond-Dybvig model.
This model, developed by Douglas Diamond and Philip Dybvig, is maybe the single most influential explanation for bank runs. It elegantly shows the bank acting as a risk-sharing intermediary.
How so?
It satisfies two groups: those borrowers who need long maturity loans and those depositors who need immediate liquidity. The bank efficiently pools the resources of these different types of customers.
And the model introduces two critical types of depositors, right? The patient ones and the impatient ones.
Exactly. The impatient depositors are those who experience an unexpected immediate need for cash, maybe a medical emergency or a sudden tuition payment.
Life happens.
Life happens. They need to withdraw early. The patient depositors are those who don't face an immediate shock. They can afford to wait and receive the full long-term return on their investment.
And the genius of the bank is what?
The genius is that, through the law of large numbers, it can successfully predict the aggregate need for cash. It services the impatient customers while keeping the rest of the money invested for the patient customers.
So stability relies on that prediction holding true. The moment that assumption of uncorrelated behavior is shattered, the whole system just flips.
And that's where the concept of the self-fulfilling prophecy kicks in.
Right.
What's fascinating here is that the run doesn't even require the bank to be fundamentally insolvent based on its assets.
It can be a perfectly good bank.
It can. A run can start merely from a false rumor or simply a perceived risk in the general economic climate. And crucially, depositors who might even know the bank is solvent and the rumor is false still have a powerful, completely rational incentive to withdraw their money if they suspect that other depositors will believe the rumor and withdraw theirs.
So your decision to participate in the panic isn't about your personal assessment of the bank's health.
No.
It's about your assessment of the crowd's irrationality. You're withdrawing your money not because you know the bank is dead, but because you know if everyone else acts as if it is, you will lose access to your cash.
This is a perfect example of the self-fulfilling prophecy, a term coined by the sociologist Robert K. Merton, who specifically cited bank runs in his work.
I didn't know that.
Oh yeah, the expectation of a negative outcome creates the very conditions necessary for that negative outcome to occur.
This brings us squarely into the realm of game theory, specifically the concept of the Nash equilibrium, as noted by former Bank of England Governor Mervyn King.
Yes, you have two equilibria. The good one, which is stability, and the bad one, which is the run.
Okay.
The good equilibrium is stable. Nobody withdraws. The bank is stable, and everyone gets the full return on their money. The bad equilibrium is also stable. King observed that while it may not be rational for any single person to start a bank run,
Right. Why would you?
once the run has begun, once that collective action is started, it becomes entirely rational for you to participate.
Why is participation so rational? I mean, break that down.
Because the bank has a limited amount of cash.
Yeah.
If you wait, you risk being the last one in line when the cash runs out.
And at that point,
the bank is forced into a fire sale of its long-term assets, selling loans or securities way below market value, which causes losses for everyone who's still in.
and if it fails completely.
You lose all or part of your deposit unless you're insured. Therefore, your only rational, self-protective move is to join the panic. Secure your money before the collective action bankrupts the institution.
So the individual rational choice aggregates into a disastrous, systemically irrational outcome.
That's the tragedy of it.
The theory is modern, but the mechanics of the run are, well, they're timeless. History shows this fragility has been exploited and exposed for centuries, dating way back to the very origins of organized finance.
The initial examples emerged as part of the broader cycles of credit expansion and contraction that defined early capitalism. We can look back to the 16th and 17th centuries in England.
Okay.
You had goldsmiths who were essentially functioning as the first banks. They'd issue promissory notes for deposited gold.
Right, like an IOU.
Exactly. But when bad harvests or wars led to general famine and unrest, people needed their gold back, causing severe failures among these early financial entities.
And the same pattern just accelerated wildly during the great speculative booms.
Oh, absolutely. You see the familiar chaos of the Dutch tulip manias between 1634 and 1637, where speculation led to a massive credit expansion and then a total collapse.
And this was mirrored by two spectacular contemporary failures, right?
It was the British South Sea Bubble from 1717 to 1719, and in France, the Mississippi Company scheme masterminded by John Law, which ran from 1717 to 1720.
And that one in France, that led directly to a run.
It explicitly led to a massive cash run on the Banque Royale after the collapse of Law's speculative empire. These events really cemented the idea that financial systems were prone to sudden, violent failure far beyond the pace of the real economy.
But what's particularly fascinating is that the run hasn't always been just a reaction to financial stress.
No.
It's been used as a proactive, deliberate tactic, a form of political blackmail or coercion.
The sources detail an amazing moment in 1832 Britain. The political climate was intensely volatile. Reformers were absolutely incensed when the government, under the Duke of Wellington, attempted to prevent key political reforms that would expand the franchise.
So how did they weaponize finance? What did they do?
Their rallying cry was brilliant in its simplicity and effectiveness. Stop the Duke, go for gold.
Wow.
This wasn't a financial rumor, it was a political command. Reformers organized mass withdrawals, urging citizens to take their golden notes out of the Bank of England and its private affiliates.
What was the goal?
They intended to deplete the central bank's reserves, paralyzing the government's ability to function and finance its operations.
And what was the practical effect? Did it work?
The pressure was enormous. Historians estimate that in just a few weeks, close to 1.8 million in gold was withdrawn. This demonstration of financial force, leveraging the inherent fragility of the gold standard system, was enough to convince the governing elite that continued resistance to the Reform Bill was impossible.
So it actually worked.
It did. The Duke of Wellington's attempt to form a government failed, and the reform was passed. It showed that if trust is the foundation of finance, coordinated distrust can be a political battering ram.
Moving forward a century, the era perhaps most associated with the catastrophic effects of bank runs is the Great Depression in the United States between 1929 and 1933.
The sheer scale of the banking crises during the Depression is just hard to overstate. Former U.S. Federal Reserve Chairman Ben Bernanke argued compellingly that the economic contraction, the prolonged depth and severity of the Depression, was caused directly by these bank runs.
Not just the stock market crash.
That was the trigger. But the bank runs, alongside the Federal Reserve's failure to provide adequate liquidity and prevent deflation, that's what made it great.
And it wasn't one single event, right? It was a wave that moved across the country.
Exactly. The geography of the panics is so telling. They began in the southern U.S. in November 1930, triggered by the failure of a major bank chain in Tennessee and Kentucky, which then just dominoed across its regional correspondent networks.
And then it hit the cities.
Then panic hit major metropolitan centers. New York City saw runs in December 1930, though they were contained. Philadelphia, Boston, Chicago, Toledo, St. Louis. Each city experienced acute, multi-institutional runs over the next 3 years. It demonstrated a prolonged and spreading breakdown of financial trust.
So what was the long-term macroeconomic consequence of all this individual panic?
Well, economists Milton Friedman and Anna Schwartz famously detailed this in their work. They argued that the steady, widespread hoarding of cash,
Meaning people pulling money out and literally stuffing it under mattresses.
literally, and that had a compounding effect. As banks lost reserves, they were forced to liquidate their loans, calling them in early or selling them off.
Which means less money available for everyone else.
Right. This act drastically and unintentionally decreased the overall money supply in the economy, leading directly to the massive economic shrinkage. The behavioral response of a nervous public translated directly into severe monetary policy tightening, completely independent of what the Fed was doing.
This highlights the critical role of regulation. Our sources emphasize that bank runs were far more prevalent in U.S. states whose laws allowed only single-branch banks.
This is a crucial comparative point. Single-branch banks are highly dependent on the success of a hyper-localized economy, which often relies on a single industry like agriculture or manufacturing.
So if the local factory shuts down,
The bank fails. In contrast, look at Canada during the same era. Canada, with its regulatory structure that permitted nationwide multi-branch banks, experienced no bank runs during the Great Depression.
not one.
Not one. The diversification of risk across multiple geographies and industries made their banks far more resilient to local shocks. It shows that while fractional reserve banking is fragile, Regulation can be the primary determinant of risk.
And fast forward to the 21st century. The 2008 financial crisis saw analogs to bank runs, even if they looked different. It was less about the public queue and more about institutional fear.
We saw what amounted to wholesale runs on financial institutions.
Yep.
These weren't typically your retail depositors queuing for cash.
Who was it then?
It was institutional lenders and investors refusing to renew short-term loans and credit lines to banks they feared were insolvent. This wholesale market run resulted in the nationalizations of institutions like Northern Rock in the UK and IndyMac in the US.
And the trigger then was what?
A combination of extremely low real interest rates and the proliferation of complex, unstress-tested financial products like subprime mortgage-backed securities.
Wow.
They collapsed the moment the housing market began to turn. But the fundamental principle was identical, a fear of insufficient liquidity to meet immediate demands.
When a run escalates to a systemic crisis, it's a failure not just of the banks, but often of regulatory oversight. Systemic crises tend to result when regulators ignore or mismanage the spillover effects of localized risk.
And that's when the government and the central bank have to step in with massive intervention tools. The most immediate is emergency liquidity support, just making sure that viable institutions don't die from a temporary cash shortage.
And guarantees.
Blanket guarantees are also frequently deployed, promising the public that all deposits, not just insured ones, are safe. Though the sources note that these interventions are complex and not always deployed successfully.
When managing a crisis of this magnitude, the sources highlight a really dangerous paradox: the delay in intervention.
Delay is the single most costly error. Intervention is often put off because regulators or politicians hope that the market will stabilize itself.
Or they're nervous about the political optics of a bailout.
Exactly. But this waiting game dramatically increases the stress and the eventual cost to the economy. The longer the delay, the more assets must be liquidated at fire sale prices, and the deeper the resulting recession. Speed is absolutely crucial.
And when they finally do intervene, not all cleanup measures are equally effective. What are the characteristics of successful crisis management programs?
They need to be specific and transparent. Successful programs are highly targeted, and they specify clear, quantifiable rules for assistance.
Like what?
This includes rapid corporate restructuring, targeted debt relief for distressed borrowers to stabilize asset prices, and crucially, transparently recognizing all the bank losses and recapitalizing those banks immediately and sufficiently.
I want to focus on a frequently proposed cleanup strategy that the sources suggest is actually largely ineffective: the bad bank concept.
The bad bank. The idea is elegant in theory. It's a government-run asset management company created specifically to buy the non-performing assets.
The toxic loans and junk securities.
Right, to take them off the private bank balance sheets. The private banks are then left with clean books, which should allow them to resume lending and investment.
But where does the breakdown occur? If the balance sheets are clean, why doesn't lending resume?
The core constraint is political, which often makes these bad banks ineffective according to institutions like the IMF. The problem is asset valuation.
How much are they worth?
Exactly. If the bad bank buys the assets at the true depressed market price, the immediate recognition of massive losses creates public outcry and anger, forcing the government to impose severe penalties on bank management.
Okay.
Conversely, if the bad bank buys the assets at an inflated price to save the bank, which is often the political reality, it amounts to a massive, expensive subsidy for failed management, putting the public at risk without restoring market discipline.
So it's caught in a political trap.
The political pressure prevents the bad bank from operating purely based on cold, necessary economic principles.
Let's shift now from that visible chaos to a kind of hidden erosion. We need to discuss the specific and insidious threat that operates below the radar of a frantic queue: the silent run.
The term silent run has evolved a bit, but one critical definition relates to the slow drain of funds tied to zombie banks.
Zombie banks.
These are financial institutions that are technically insolvent due to large unbooked loss exposure. They have huge implicit fiscal deficits, but they continue operating, often propped up by temporary government support or just accounting tricks.
And as doubt about them grows, the silent run puts pressure on everyone, not just the zombie bank itself.
Exactly. Healthy competitors are squeezed because the zombie bank is destabilizing the entire system. When funding costs rise, zombie banks often pay higher interest rates to roll over their liabilities, which squeezes the profit margins of healthier, better-run competitors who now have to compete with those subsidized rates.
So the bad actor drags down the good actors.
Yes, and furthermore, if a zombie bank is forced to sell assets, the mere knowledge of their distress can drive down the market value of those assets, imposing capital losses on healthy banks that hold similar assets. It's a systemic contagion caused by slow, persistent decay.
Our sources also present a second definition of the silent run, one that's relevant in countries that do have deposit insurance.
This is a subtle but really telling behavioral pattern. It describes a phenomenon when insured depositors who know their funds are safe up to, say, $250,000.
They don't empty their accounts completely.
No, but they draw down their balances to just below the deposit insurance limit.
Why do this if their money is supposedly safe?
It's a calculated, cautious vote of no confidence. It indicates that they trust the insurance limit, but they doubt the government's ability or speed to make good on promises for amounts above that limit.
Or they're afraid they just won't be able to get their money when they need it.
Precisely. They fear the lack of immediate access might still cost them opportunities. By moving funds down to the limit, they signal doubt about the system's liquidity and operational capacity, even while acknowledging the financial guarantee. It's a powerful, quiet signal of rising systemic distrust.
The history of bank runs shows that stability requires both projecting confidence from the individual institution and reinforcing the structure globally. Let's start with the almost theatrical individual techniques used historically to avoid triggering a panic.
Individual banks understood that psychology was their biggest enemy. Historically, they invested heavily in just projecting stability.
The architect.
This is why you see classic banks built with massive, heavy stone facades, marble columns, bronze fittings. The sheer physical weight and permanence of the building was intended to communicate that the bank was heavier and more permanent than the fleeting fear of the market.
And the staff, too?
Similarly, staff were encouraged to dress conservatively to project an aura of reliability.
And before the existence of federal deposit insurance, the physical layout of the bank itself was a primary defense mechanism. It was literally about hiding the line.
Literally. It made sense for a bank to have an extremely large lobby and highly efficient service staff. Why? Because the main signal of a bank run to passersby was the queue spilling onto the street.
So if you keep the line inside.
If the lines were contained inside the enormous lobby, people walking past were unaware of the crisis unfolding within. Stopping that visual signal from reaching the street was a key psychological tactic to prevent fear from spreading outside the bank's walls.
And if a run started anyway, banks sometimes resorted to clever, albeit manipulative, tactics to slow the momentum artificially.
Yes. The goal was always to buy time for the central bank or other sources of liquidity to arrive. A common tactic was to enlist employees' friends and relatives to stand in line and conduct many small, slow transactions.
Really?
Oh, yeah. Paying out small amounts in diverse forms of currency, anything to artificially slow the flow of genuine withdrawals. It gives the appearance that the bank is operating smoothly, but just slowly, which drains the depositor's momentum and adrenaline.
And then there's the opposite tactic, the visible show of reassurance.
Right. Scheduling prominent, highly visible deliveries of cash, often in armored cars, making a point of wheeling large carts of notes into the vault in full view of the public.
A bit of theater.
It's a deliberate show of force and liquidity, designed to convince panicked participants in the line that the vault is being actively restocked, thereby removing the scarcity mentality that fuels the rush.
Ultimately, the most powerful psychological weapon for a bank facing a run, short of actual failure, is the threat of suspension of convertibility.
Temporarily suspending withdrawals stops a run dead in its tracks. But the interesting finding from our sources is that the threat itself often proves enough to prevent the run from fully materializing.
How does that work?
If a bank can credibly signal that it's about to stop payments, it changes the depositor's calculus from "I must withdraw now or lose my cash" to "If I withdraw now, I might trigger the suspension and lose access entirely." That shift in fear can sometimes pause the panic long enough for regulators to step in.
Okay, so let's move to the systemic techniques. The massive firewalls built into the entire financial architecture that protect the whole economy. The most important one in many countries is deposit insurance.
Deposit insurance, like the U.S. Federal Deposit Insurance Corporation, or FDIC, is designed to interrupt that self-fulfilling prophecy.
How?
By insuring deposits up to a certain amount, it removes the individual depositor's rational incentive to withdraw simply because others are doing so. For the vast majority of retail depositors, their money is safe regardless of the bank's solvency. The reason to run is gone.
But you mentioned earlier that depositors still fear a lack of immediate access during a bank failure. How does the FDIC address that specific fear?
The operational strategy is key here. The FDIC doesn't just guarantee the money, it guarantees continuity. They keep their takeover operations secret, conducting the sale or restructuring over a weekend.
So no one knows it's happening.
And then the branches reopen on Monday morning under new ownership, usually a bridge bank or another solvent institution. This prevents the run fears associated with the multi-day lack of access that historically accompanied bank failures. The seamless transition reinforces public trust in the system's resilience.
The second massive systemic defense mechanism is the central bank's role as the lender of last resort.
This is the ultimate safety valve for the entire system. The central bank guarantees that it will provide short-term loans to solvent banks facing unexpected liquidity demands. This foundational role was analyzed extensively by Walter Bagehot in his influential 1873 work, Lombard Street.
And his classic dictum was that the central bank should lend freely at a penalty rate on good collateral. Let's break that down. Why freely, but at a penalty rate, and only on good collateral?
Okay, lend freely is to address the panic, to assure the market that liquidity is unlimited and the crisis will not spread due to simple cash shortages.
Got it.
On good collateral means the central bank is not bailing out an insolvent bank, only a liquid one. This minimizes taxpayer risk.
And the penalty rate?
The penalty rate is crucial because it addresses moral hazard. It makes it expensive for banks to rely on the central bank, which incentivizes them to manage their own liquidity prudently in normal times.
We also have structural regulations designed to reduce the possibility of insolvency in the first place, like capital requirements.
Rules like the International Basel III Accords dramatically strengthen requirements on how much capital banks must hold and introduce new regulatory mandates on liquidity and leverage. If a bank is forced to hold a greater buffer of high-quality capital money that can absorb losses, the less likely they are to become insolvent.
Which reduces the primary fear that triggers a run.
Exactly. If a bank is less likely to fail, the rational incentive to run is diminished.
But this entire edifice of safety deposit insurance, the lender of last resort, it creates the classic problem we hear about in finance, moral hazard.
It does. If we connect this to the bigger picture, the safety net, while necessary for stability, inherently reduces the bank's own incentive to avoid risky behavior.
Because they know they'll get bailed out.
If management knows the government will step in to prevent a systemic collapse, they may take on excessive risk. Regulators face a calculated trade-off.
Which is?
The collective societal benefits of preventing a catastrophic systemic collapse are generally believed to outweigh the costs associated with the increased risk-taking, provided that regulations like Basel III mitigate the worst excesses.
The final and rather novel idea for mitigation comes in the form of a theoretical mechanism involving withdrawal fees.
This concept is modeled as a Pigouvian device. A Pigouvian device, a fee intended to correct a negative externality, which in this case is the self-destructive behavior of the bank run. Withdrawal fees would be levied by the bank on successful withdrawals, potentially increasing in proportion to how fast deposits are flowing out or how close the bank is to its reserve limit.
So you're literally putting a price on panic.
You're pricing the panic, and it directly targets the rational calculation of the running depositor, particularly the uninsured wholesale depositor, whose money is too large to be covered by insurance.
And the goal.
By imposing a sudden price on the withdrawal, running is no longer the most obvious rational strategy. It forces the depositor to pause, calculate, and consider the cost of joining the run, thus reinforcing the stability provided by other mechanisms. While it's not widely implemented in commercial banking, similar techniques are used to price liquidity risks in markets like cryptocurrencies and money market funds.
We started with the classic cinematic cue, but the reality of the 21st century is that panic moves at the speed of light, not the speed of a cue snaking around a corner.
Whole different ballgame.
This introduces the new urgent category of threat, the cyber run.
The cyber run is a critical modern distinction. It's defined as a rapid, massive withdrawal of deposits that is precipitated not by fears of credit insolvency that the bank made a bad loan, but by a systemic operational failure, often caused by a cyber attack.
So the fear isn't that the bank has lost money, but that I, the client, will lose access to my money when I need it most.
Exactly. Depositors might believe the bank is solvent and holding healthy assets, but if a crippling cyber attack disables online banking, card settlement, or ATM networks, they fear losing timely access to funds or the ability to settle critical payments. They run to ensure they maintain control before the system locks up entirely.
And the problem here is just acceleration. Current regulatory assumptions were simply not built for this velocity.
This is a major regulatory challenge. We have the liquidity coverage ratio, or LCR, which requires banks to hold sufficient high-quality liquid assets to survive a severe 30-day stress scenario.
Okay.
The LCR is based on specific regulatory-defined outflow assumptions over that 30-day period.
What does research show happens when you introduce a cyber run scenario into that LCR framework?
Well, simulations for systemically important banks have demonstrated that cyber run outflows could arrive much faster than the LCR assumptions allow for.
Not 30 days.
Instead of 30 days, you might have hours. If a key payment system node is compromised, the liquidity shortfalls could spill over to the entire economy instantaneously, creating a situation where the banking system faces operational gridlock, even if individual banks theoretically hold enough assets.
And this accelerated speed isn't theoretical. The digital age has proven it. The collapse of Silicon Valley Bank in 2023 serves as a really stark illustration of velocity.
It was stunning. While the SVB run was triggered by solvency concerns related to bond losses and a failed capital raise, the collapse was absolutely accelerated by digital speed.
How fast?
Customers withdrew $42 billion, nearly a quarter of the bank's total deposits, within a single 24-hour period.
$42 billion in a day.
That unprecedented, instantaneous velocity was only achievable through digital banking and wholesale treasury management platforms. The bank didn't have 30 days. It had one.
And for an example of an explicit operational shock triggering a run, we can look to the case of Iran's state-owned bank, Sepah.
Right. In June 2025, Bank Sepah was hit by a destructive cyber attack that disabled core banking functions. Online services, card payments, and many ATMs were just down. The operational failure instantly triggered a physical run.
So the digital failure created the physical queue.
Precisely. Long queues formed immediately outside the remaining operational branches as depositors rushed for cash. This forced the bank to impose ad hoc withdrawal limits and temporary closures.
And the panic spread.
It spread so rapidly that the central bank had to intervene days later, declaring a 50% increase in liquidity supplied to the entire banking system. Behavior analysts confirmed it was a classic bank run, but the trigger was purely operational failure, not credit risk.
So if the technology is moving faster than the regulations, what are the proposed safeguards against these ultra-fast cyber runs?
Regulators are recognizing they need operational firewalls. One key proposal is the creation of an emergency payment node.
What's that?
Think of it as a dormant, narrow, pre-authorized payment bank activated only during a systemic operational outage. Its sole purpose would be to process critical wholesale payments between vital financial firms, maintaining payment continuity when the main platforms are down.
And regulatory oversight itself needs to evolve to match the threat.
Absolutely. Regulatory stress tests must now incorporate cyber run scenarios with the same rigor traditionally applied to credit risk. We need to be testing for operational fragility and velocity.
You have to ask.
You have to ask. Can the system process high-volume, rapid withdrawals during systemic failure? Or will the platform itself become the point of failure? This requires anticipating how rapidly fear can be communicated and actioned in a world of instant digital transfer.
So we've covered a massive amount of ground today, tracking the bank run from the 17th century goldsmiths to the instantaneous digital chaos of today. And the core takeaway for me remains absolutely constant. The vulnerability of banks stems from their essential beneficial role as liquidity providers.
That's it.
They take illiquid, long-term risk like loans and transform it into liquid, short-term security, our deposits. That asset-liability mismatch is both the architectural necessity and the architectural flaw.
And we saw how that vulnerability scales, from the individual run to the panic, culminating in a systemic crisis that can cost a nation a fifth of its GDP in lost output.
Yeah.
The psychological loop, that self-fulfilling prophecy, is what transforms rational individual action into collective economic destruction, driven by the game theory of who gets out first.
And this financial reality, this deep fear of scarcity and loss of access, is so deeply imprinted on our collective storytelling. The bank run isn't just a dry economic concept.
Not at all.
It's a dramatic pivot point in fiction. From the crisis at the building and loan insecurity, It's a Wonderful Life, to the run on the bank in Mary Poppins, or the classic 1932 film American Madness. These cultural references show how real economic trauma just leaves a lasting mark on our narratives.
So what does this all mean for you, listening to this? We learned that a bank run is essentially a rational panic based on distrust in the institution or the system.
Right.
Given that the modern safety nets, deposit insurance, central bank liquidity, are designed to eliminate the financial incentive to panic, this raises an important and I think provocative question.
Which is?
When digital velocity allows billions of dollars to move in a single day, is the ultimate defense against a modern bank run less about physical reserves and more about instantaneous, unwavering public trust, transparency, and effective communication?
Especially when operational failures can trigger a panic just as easily as insolvency fears.
Yep.
The speed of information and the speed of digital finance means that maintaining stability in the 21st century requires not just deep balance sheets, but absolute instantaneous confidence in the integrity of the system itself. Something for you to mull over the next time you tap your phone to check your balance.